All right, guys, what's going on? This is Ryan, aka Cantor and Clark, and it is 10:18 a.m. New York time on Wednesday, May 13th. And on behalf of Josh Rager and I, we just want to welcome you to the BlockRoots YouTube channel. If you're not already a subscriber, make sure that you go ahead and not only click the like button, but subscribe to the YouTube channel. For those of you that are subscribed, if you leave a comment on this video below, you'll be automatically entered in to win $100 in Bitcoin. And I have two really important pieces of information for you today. One that I am very excited about, and I've been excited about for quite some time, and now I am finally able to talk about publicly. So let's get right into that. And first, we're going to get into what for me is a very big piece of information, but this is something that I expected was coming down the pipeline for quite some time. All right, so JP Morgan takes on Coinbase and Gemini as its first crypto exchange customers. Now, this comes in stark contrast to anything that we've seen over the last few years. Traditional banks have been quick to shut the doors on pretty much anything crypto related and shunned crypto as a whole. Now, what the argument was to protect customers from risky and speculative assets, but we know that banks have a vested interest to keep control over any client's capital. So one of the main arguments for crypto is not only to bank the unbanked, but to allow self-sovereignty and control over your own personal wealth. So pretty much anything that comes out of the system hurts legacy institutions. Now, we've seen this time and time again with technology, with science, where the old guard sometimes always seem to try to snuff out the new. So anything that represents progress might represent them shutting their doors. So it's a threat. But eventually you see that if you can't beat them, you join them. There's too much capital to be made, and this is just the direction that we're seeing finance move. So this is pretty big information, and it was a long time coming, and the first to move will likely benefit the most, but then it'll just be a race at that point. When you are a large institution and you're essentially the last to step off zero, most of the opportunity at that point is behind you. So that's why risk is given, or reward is given to those who take the most risk early, right? They're sticking their necks out there. So this is pretty awesome. JP Morgan banking Gemini and Coinbase is huge, and I would expect a lot of other institutions to follow. So now let's get to our next piece of information. And this for me is very exciting because, as you know, Josh Rager and I are partners with Femex. So we're going to go over to Phemex.trade to check out what their unveil was this morning. All right, so now on to the exciting news. So as we all know, Femex is the fastest cryptocurrency derivatives exchange, but they just added one more feature to the many features that they're going to be adding over the next few months. They are now not only the fastest derivatives exchange, but they're also now going to be the fastest crypto spot exchange. So Femex is going to be offering spot trading for all of their current pairs, and it doesn't end there. They're going to be offering zero fee trading. So essentially, this is going to be a subscription model. And what it boils down to at the base level is that for less than 2 Starbucks coffees a month, you can trade spot crypto for free. Now, this is huge. So most traders, especially new traders, don't realize how much trading costs or trading fees eat into their bottom line. Now, it's hard enough to be profitable on its own. Okay, so imagine trying to be profitable when you not only have to come up with a working strategy, but you have to deal with transaction costs such as slippage and trading fees. So normally when you're on an exchange, if you're taking liquidity, you're going to be paying a fee. On some exchanges, you'll receive a rebate. So if you're trading derivatives on Femex, you'll still receive a market making rebate. But on other exchanges, not only do you pay a fee for market taking, but you also pay a fee for market making. So Femex is going to be offering zero fee trading for their spot trading, which is huge because all traders are transaction cost sensitive. So being able to mitigate for one area or one cost can only benefit your ability to do well in the long run. So we can actually, right after this, look at fee structures on other competitors' websites. All right, so let's take a look at two of the larger competitors within this spot space. So what we have here is Binance's fee schedule. And right here we have Coinbase's fee schedule. So fee structure, fee schedule, same thing. Now, both of these incentivize people to trade more. Binance actually takes it a step further, and for reduced fees, you can either trade more or hold a larger amount of Binance's exchange token. Now, what you can see on both of them is that you are paying a fee regardless of whether or not you are a taker or a maker. Only on Coinbase, after you exceed $100 million in transaction volume a month, do you immediately at that point drop down to 0 maker fees? So on derivatives platforms, normally when you're providing the exchange with resting liquidity, you're going to be incentivized to do that because you're going to receive a small amount of compensation. There's none of that on Coinbase, and there is none of that on Binance. So you can actually see that on Binance, the exchange does not drop off taker fees, or rather maker fees, at any point. Even when you're above the highest amount of traded volume and the highest amount of held Binance token, you're still paying at that point over 1 basis point to be a provider of liquidity. Now, if you look at Coinbase, it's absolutely ridiculous. Under $10,000 in trading volume, and for a round trip, meaning for an entry and an exit, you're paying 1%. So for that first trip, you're paying 50 basis points, so 0.5%. And then to get out of that position, you're paying another 50 basis points. So you can just see how this is essentially highway robbery at this point. So the fact that Femex is going to be offering 0 fees for a subscription model is incredible. So for a very small amount of money, you could completely eliminate this kind of cost. And again, this is a cost that really eats into anyone's trading approach. So imagine trying to be a new trader, trading spot, not even trading derivatives, trying to develop a profitable strategy and dealing with things like these astronomical transaction costs. So it's important, though, you understand what it means normally to be a taker or a maker. So I want to go over that really quickly because I know I might lose somebody on that. So when you're a maker, more often than not on derivatives platforms, so if you're trading Femex futures, if you're making, that means you're providing liquidity. So you're using a limit order. Now remember, a limit order does not guarantee execution. It just guarantees price. But when you place a limit order, you are providing the exchange with resting liquidity. So when I place a limit order to sell, I'm placing an offer. When I place a limit order to buy, I am placing a bid. So I'm relying on a counterparty at this point to take the other side of my order. So it's resting liquidity, and for providing the exchange with liquidity, I am incentivized and paid a small fee. So this is good because in essence, I'm receiving money to place an order. When you use a market taking execution, such as a market order, you're going to be paying a fee. You don't only pay a fee, though, when you use a market order. So if I was to jump the spread and buy, I'm going to be paying the spread and paying that fee. So imagine if you have a strategy that involves getting in and getting out very quickly and using market execution. You're going to be paying a lot of money just to incorporate that strategy. So as you can imagine, the fact that Femex is going to be offering 0 fees for only a small amount of money, this benefits everybody. So I'm just going to show you really quickly the difference between P&L before fees and after fees. All right, so what we're looking at right here is a bunch of data that I was gathering when I was testing out a new long-only strategy for Link. And I tested this out on a small scale. I wanted to see how transaction cost sensitive it was and how profitable it was. Now, it turns out that it was profitable. So it did quite well, and I'd been running this since the end of February separately. But on a small scale, given that it was barely a fraction of what I normally trade, even though it was profitable, it would likely only get worse as I increase my size. So the fact is that it did well on the lower scale of things, but with increased size, given that I was paying the transaction fees and market execution, those issues, those transaction costs would only be exacerbated in a negative way if I increase the position size. So this is going to be a good indication or example of how transaction costs, or in this sense, trading fees, can affect your bottom line. So what we're going to do is we're actually going to plot this. So we'll go ahead and show off our Python skills. So trading data, and then we'll do closed P&L. Okay, and then we'll do cumulative sum, and then we'll plot that. And we'll see that right now, this is our closed P&L. So this is our closed P&L without fees. Now, what we're going to do is we're going to actually increase this size so that it makes it a little bit more easy on the eyes. We're going to make this, let's say, 40 by 16. Okay, so now we're going to show what this looks like if we had our fees. So we're going to just add this, make it very simple. In this case, realize P&L. and you'll see immediately the effect of trading fees on your bottom line. So here we have our closed P&L, and here we have our realized P&L. Now, one of them is obviously drastically different from the other. You can see that from this strategy, we paid $242 in trading fees, and our realized P&L was $517. So now imagine the benefits of using an exchange like Femex and not having to pay any trading fees for that small amount of capital upfront. All right, so if you want to trade spot for 0 fees, go ahead and go to Phemex.trade, and you see that the end of an era begins in less than 2 days. So that can't be it though, right guys? We need to go over a little bit of Bitcoin analysis before wrapping this up. All right, so just a simple higher time frame analysis and lower time frame analysis. So the most important level on this chart right now is right around this 10,500 level. That was our ceiling back in October. That was our ceiling in the beginning of 2020. We have not closed above 10,500 since June 2019. So that's our major contextual level. What we have here is 8 back-to-back green weeks off of this very violent capitulatory low, approaching this area of market structure. You're going to expect some type of reversion to the mean. So that's what we got. We got our first significant and abrupt pullback on the higher time frame. So significant and abrupt, you know, it's only a 20% pullback off of the high, which is not really much by Bitcoin standards at all. But we have to remember that as we approach a significant level like this, okay, so our last weekly high, this is going to be your strongest resistance. As you approach this, the closer and closer you get, the more your long risk reward shrinks. So it becomes less and less attractive to consider a long because we're approaching what should be, in this case, our first take profit or our first sticky area or our first area where we could expect a good amount of friction. So for me, that 10,500 is the level. It is the level that if we build structure on something like the daily chart, that we could get in more or less send it mode. So let's say we close above 10,500, briefly break back below, and then manage to close back above and put in some type of bullish market structure. Well, to me, that says that the trend in this case is holding up for a change. So the trend that's changed is the fact that we have not been able to close above this structure. It is that key contextual level, and now we're beginning to put in a change in market structure to the upside. So above 10,500 in that regard, and I will more or less be in send it mode. So I was in send it mode from 7,250 to above, but that was only up to this high. So right now we're still sitting below that. There is an argument to be made for the fact that this is now becoming a more attractive short opportunity because you can define your risk a little bit more cleanly around this level. So looking down at the lower time frame, I pay attention to, and sometimes I lose people talking about this. I don't want to lose anyone in this. So what I pay attention to is where price distributes through time. And what I'll do is I'll begin to develop a composite of where 70% of that distribution occurred. So I'm not always looking at a weekly level or a daily level from, closing basis. I'm looking at where we spent the most amount of time, where that is occurring from a density standpoint, and where we are transacting the most volume. So you see that right now, these blue lines indicate my value composite I had established from back here, this April 30th to May 6th range. So price moved above, made an aggressive move upward, but what we saw up here was not so much that sellers were really aggressive, it was that buyers more or less lost momentum. So buyer aggressiveness really stepped off. We saw delta drop, and what we had was a cascading long liquidation. So anyone who placed stops below these lows in microstructure, they were liquidated, and price found its footing temporarily below this previous range, which was kind of important, right? You don't want to lose an area like that within market structure. So we began to range again. In this case, we went from high volatility to actually greater volatility, which is not something I normally like to see if I'm going to see a range progress over time. Normally, you'll see that you'll go from high volatility to low volatility, and then I'll have a little bit more clarity in terms of the break. So if we break this level. What we did get was an increase in volatility. We began to develop a composite range, and now we've actually overtaken this previous range composite high. So from here, normally when we have a gap down like this, if we regain this single print level, so the area where the gap is apparent, you're looking at majority of the structure. If we regain this level above market structure, I'm usually just looking at this going from point A to point B. So in this case, from 9,000 to right around 9,500, 9,450. So that's what I more or less expect to happen right now. I've been gearing up for this trade since 8,850. It's a long opportunity because it's acceptance above the value area that we're beginning to create through distributing over time, in this case the last 3 days. We gained acceptance to the upside and are more or less looking at this as a potential target. What I will say is that it is grinding upward right now, okay? The long is there. The short might be there as well though, right? The short might be there arguably from a loss of support, right? And this being rather a loss of support, now it should act as resistance. What I'm getting to and what I'm losing in the case of my sticky tongue is the fact that this might seem like such an obvious short opportunity that it'll actually just squeeze upward and end up resolving in us ripping upward. A lot of the times you'll see that one of the popular patterns in Bitcoin is we'll for example, we'll have a range, we'll have a previous range. Let's get that correct. Draw that again. So we'll be ranging, break up, create a new range. On a dump down, we'll completely violate a previous structure. Capture a good amount of liquidity below this low, okay, because a lot of people in this case are presuming that because we lost market structure, we need to continue to the downside immediately. Capture that aggressive order flow, and then the first place that you'd expect take profit or shorts to occur, the most obvious place to take a short, ends up fueling that liquidating move upward. So there's 2 points in which traders are caught off sides within this structure, and I just say be careful for that right now, because there's a lot of people that might be looking to short this this 9,500 level, this 9,450 level, and it could be that they start creating what is that offsides positioning as price continues to squeeze upward. So right now, the most important thing to me is that we've actually regained this previous composite, that previous 9,000 high, and we're beginning to put in a move to the upside. It's not so obvious to me that this is bearish, the fact that we dumped like that. What that was essentially was a drop in momentum and long liquidations, like I said, in any trend upward. So over time, as you're trending upward, it's not always going to be that prices are just going to continue up indefinitely. You're going to have a point where buyers begin to step off the throttle. That's why we look at something like momentum and delta. You're going to have buyers step off the throttle, and you're going to require for this trend to continue that sellers take the opposite side of the trade. You need them to get trapped to create the further squeezes upward. So buyers lose momentum at a high. Sellers begin to gain a little bit more confidence into a low. We get a break of market structure. They get trapped, and then we fuel that whole process and cycle upward again. So that pretty much covers it, guys. We covered a lot in this. Take a look at Phemex.trade. In 2 days, there will be feeless spot trading, which in my opinion is absolutely tremendous. On behalf of Josh and I, we just want to thank you guys for tuning in. Have a great week. Hopefully everyone is doing well right now, still in quarantine. But as always, guys, exercise proper risk management and trade effectively.